I start out like, first of all, welcome and thank you so much for taking the time to spend it with us at this event. We are so thrilled, Ava and I, we are so thrilled to have Kyle Argo from Equiton. Another way of investing in real estate, a more passive way, and we really got involved with that and we loved it, and we thought we share it with you. It's a great option, but we will talk about this a little bit later. If you have any questions, please put it in the chat line. We will follow up with the Q&A afterwards. And don't worry, we will also tape it and record it and send it out to you at a later stage, right after that. Kyle, why don't you take over the mic and introduce yourself, introduce your amazing product, what Ava and I have also invested in, and we love it.
Yeah, happy to be here. Thanks for having me again, obviously. And I'm here to tell you guys about a different way of investing in real estate. Typically, when people think of investing in real estate, they think of actually buying and managing properties themselves. But there are other alternatives to ways that you can get involved in real estate that are a little bit more hands-off. I work for a company called Equiton, which we are a private passive real estate investment firm. And I got a presentation that I'm going to do for you guys today. And it's going to go over a little bit more detail what that actually means. So without further ado, let me pull up my presentation here and we can go into it in a little bit more detail. So just bear with me for 1 second here. Share screen. Go. Here we go. All right. So can I just get a thumbs up from you, Sophia, that you guys can see my screen here now? Awesome. So let's start this here. So before I go into it too much, I want to tell you guys a little bit more about me. Again, my name is Kyle Argo. I'm an associate vice president here at Equiton. I run our sales team here. And I've seen Equiton absolutely explode. And I really believe that it's because not a lot of people knew that this type of investment actually existed until prior to 2015. Prior to 2015, private companies like Equiton were only available to really high net worth individuals or institutions to invest in. So I like to call this the best kept secret of the investment space because it's still something that isn't mainstream, that everybody knows about. So myself, right out of school, I started working for one of the biggest banks, TD, and I became a financial advisor there. And I always knew that I had a passion for real estate. I always knew that real estate was something that I personally wanted to invest into and that I personally believed in, not only the fundamentals, but also the specific macroeconomic environment that Canada has specifically that really push real estate as an investment moving into the future. And being at the big bank, I just didn't believe in everything that they had to offer. I didn't believe in necessarily putting all of my money in mutual funds or stocks or bonds or those type of assets, because being on a public stock market, they're very volatile and they go up and down significantly. So I ended up looking for other career alternatives, and I found Equiton, which I'm very happy that I did. When I first found them, really what I wanted to do is kind of learn what they were doing and kind of mimic it and do it on my own. But getting involved and learning more and more about what they have to offer, what we have to offer, I should say, I really bought in. And that's one of the reasons why I've been here for almost 5 years at this point, and I really have been an integral part of helping build this company into what it is today. At this point, I manage about 500 different clients on my own. I manage about a book of $44 million in terms of assets under management that I've been able to bring into Equiton. And I actually am an active real estate investor myself. I actually bought my first rental property at the age of 25, which seems like an eternity ago at this point. But so I've been there. I know what you guys are going through, and I hope you guys can get a little bit out of what I have to talk about today. You guys might notice in the corner here a QR code. If at any point in time you're interested in learning a little bit more and you want to book a one-on-one with me directly, just scan that QR code. Your information will go directly into our system, but it'll go directly to me and my assistant, Madison. He'll reach out to you at some point next week and he'll book you in the calendar. We can go into anything in more detail. You'll see those throughout the presentation. So feel free at any point in time just to scan it with your phone and you'll go right in and we'll reach out to you at some point this week. Now, some of the things that we focus on at Equiton and some of the things that we're really proud of here is that we're 100% Canadian, 100% Canadian focused. Again, we believe in the Canadian macroeconomic environment that has unique characteristics, especially in today's world, which I'm going to go over with you in a little bit more detail further on, that really support real estate growth, especially in prices moving into the future, which is an opportunity for all of us as investors. Another thing is we pride ourselves on making real estate accessible to all Canadians. As you guys know, when you're buying properties, there's certain hurdles that you have to get over. And again, in today's environment, it's becoming more and more challenging to come up with the down payments that you need or securing financing, or even if you're getting to the top of it and you already have a portfolio, being able to expand it as much as you want. Not to mention, we also help Canadians get more diversification within their real estate portfolio. So even if you own 50 doors, let's call it, and you're doing fantastic on that side, you're likely mostly saturated in that side of the market, which is single family housing or even multifamily. We also allow people to invest in things like development projects and things like commercial lending, other sides of it, so you can get a full scale, more diverse real estate portfolio as well. I want to introduce you to the people at the top because without them, really, we wouldn't be who we are. And we wouldn't have seen the growth that we've been able to see without having experts at the top who know what they're doing. This gentleman here, his name is Jason Roque. He is our president and CEO. He's the person who started Equiton back in 2015. He quite literally was born and bred into real estate. His family owns a development company called Live Communities. That's LIV Communities. They're still in business today. He, after going to school, ended up working for a developer right away, ended up actually becoming president and CEO of that company. But he had bigger aspirations and he wanted to do things his own way. So he ended up getting a fairly large payout back in 2015, and that's how he was able to start Equiton. This here is Helen Hurlbut. She is our co-founder. Jason's right-hand woman in this case. She is an extremely passionate and impressive individual, if I must say so myself. She is a managerial accountant by trade. She holds the position of CFO, Chief Financial Officer here at Equiton. She is the financial guru behind everything that we do. And she has held very high positions at some of the most renowned real estate companies in all of the country. One that probably most of you guys have heard of would be Mattamy Homes. She was a executive vice president for Mattamy, and she's one of the people who helped build that company into what it is today. So her reputation exceeds her for sure. Now, outside of those two, I just wanted to introduce it. We do have a very elaborate senior management team who has tons of experience in real estate specifically. They've managed over $40 billion worth of assets, managed over 27,000 individual apartment units. They've developed over 100 million square feet of land and collectively have over 200 years of experience. Now, why that's important is this. I always lean on the numbers and research because to me, that's what makes sense. And to me, that's what tells a story. And if you, oh, sorry, went a little bit quick there. Let's go back. If you look at the numbers here, going from $20 million in assets under management to over $1 billion in 8 short years really goes to show proof of concept, really goes to show that these people know what they're doing. We have a proven model, and we've been able to provide a lot of value to our investors because you're able to take advantage of the experience of not only the 2 individuals who I introduced you to, but also the rest of the senior management team. And what's even more impressive about these numbers going from 20 to over $1 billion in assets under management is the environment that we were in. Keep in mind, from 2020 on, we were in COVID, and then we were in an inflationary crisis. So to be able to foresee through these type of crises and be able to find value for our investors and be able to build the portfolio into what they have today, to me, just is extremely impressive. And we truly wouldn't be where we are today without that of our senior management. Now, 1.06 billion is just assets that we have under management. So that's what we're currently managing. We also do developments, and we have about another over $1 billion worth of development projects on the go. So with completed projects as well as assets under management, we're looking over 2 billion at this point, which again is extremely impressive, especially considering the environment that we've been able to do this in. Now, I want to go back to one of the concepts that I was speaking about before, which is the active versus passive. Now, as I mentioned, Equiton is a passive real estate investment firm, meaning we're doing all of the work on behalf of our investors. But a lot of people think of the active side when they think of investing, which is something I was alluding to before when I said that you're buying and managing properties yourself. Now, I'm going to be the first to admit that when you're doing active management of real estate, you'll probably make a little bit more money in that case because you're doing all of the work yourself. But there's always a trade-off, time and effort versus money that you actually make. So how much time and effort do you actually want to put into the properties, and how much risk do you want to put into it as well? I really see this as more for experienced investors, because you need to really have proven models, and you need to have be doing due diligence, running financial modeling, making sure that you're on top of capital expenditures, and really running it like a business. So of course you can make more money doing it this way, but be a little bit more, not weary, because that's the wrong word to say, but just know that there's going to be a lot more time and effort that you have to put in on your end, essentially. What I mean by limited property types here is, again, usually when people are buying real estate, they're buying single family housing. At Equiton, we do things on an institutional level. We build condo buildings ourselves, so you can get involved in the whole process rather than just buying a unit or something like that in a condo, which means that you get to take advantage of the profit from the developer side rather than banking on appreciation after the fact once it closes. Think of things like large scale lending. We do land and construction loans to development companies so they can actually purchase a piece of land or clear it and build on it, which typically has a little bit higher yielding interest rates because of the risk that's taken on. But because we're a development company, it mitigates a lot of the risk that's involved in that side, because if they were to default on these type of loans, we're a development company. We could pick up where they left off, right? We also do multifamily, but in a larger scale. Multifamily is defined as 5 or more units within one structure of a building. We do this on an institutional level. I believe our biggest building is pushing 400 individual units. So you get to take advantage of all these type of property types. Plus, you don't have to secure financing, down payments. You don't have the challenges of property management. You're not getting calls at 4 o'clock in the morning because a toilet blew up. Again, you kind of get to sit on the sidelines and trust the experts to be managing these properties on your behalf, but you're a partial owner in it as well, and you get to take advantage of all the advantages of it as well. Kind of like my friend here, you could quite literally be on a beach sipping on a pina colada somewhere and not have to worry about any of that side of it, and let us do all the effort while you get to reap the benefits of what we do here. What it does is it really lowers your overall risk because you're investing in very diverse portfolios. And another huge advantage of this side of the game, let's call it, is that you can use your registered monies. So when you're buying properties, obviously you can't use your RSP. You can't use a TFSA. You can't use a LIRA. You can't use your kids' RESP. You can't use any of those type of things. With these, you can use any and all of them. So if you have money just sitting in an RSP that's been getting beat up in a mutual fund over the last 4 years and you're barely earning money, you could use those type of monies to actually get real estate exposure in your portfolio and be able to take advantage of the returns that are associated with it as well, which is something that I think you'll find really refreshing when we get to that side of it. Now, that's the passive side. So remember at the beginning, I said, we're a private passive real estate investment firm. So I went over the passive side. That's what makes it passive, is that we are the ones doing all the work on behalf of our investors. But being a private company as well, what that means is that we're not listed on a private stock exchange. Because a lot of people will come to me and they'll say, Kyle, that's great, but why don't I just buy into a public REIT that I can buy through the bank? And being listed on a stock exchange creates a lot of volatility. And the reason why, let's go into this a little bit more. Really, you want to get more diversification within your portfolio, number one. So I'm sure this looks familiar to everybody. This is essentially, if you were to walk into a bank, and you were to say, I want a diverse portfolio, this is what it would look like. They'll put you in 60% equities, which is like stocks, mutual funds, that type of thing. And then they'll put you in 40% fixed income, which is like GICs, bonds, essentially something that's paying you. Okay. But this is becoming more and more of an older paradigm because they call this diversification, but you're entirely in public markets. Now, I don't care which type of public market fund it is. It's listed on a stock exchange, which is going to create a lot of volatility just based off the fundamentals of how these are traded. Which, if we go into it a little bit more, how are they traded? So if you look at, again, the equities portion of this specifically, things aren't the way they used to be. What I mean by that is looking back to the Warren Buffett, let's call it, style approach of investing, which was a great way of investing, which is every single company that you want to put in your portfolio, you're going to go through the financials, you're going to look through the senior management, you're going to make sure that the leaders are there who are qualified to run this business, as well as the financials are there to support the growth moving into the future. Not a lot of people are doing that moving into today's, let's call it, digital world. Everything is really quick. All the information's coming at you really fast, and things are just flying by. Now, what that's doing is it's creating more speculation than we've seen in decades. Not a lot of people are doing the actual research, and we have certain influencers that push the needle on stocks, which that should never happen. As an example, somebody like an Elon Musk will tweet something, and all of a sudden a stock will go up 10, 15%. That's so speculative now that, in my personal opinion, this is more of a gamble than anything moving into the future. Now, having public markets in your portfolio is extremely important because it provides you with something that's really important called liquidity. So if you want your money instantly, you could quite literally buy these stocks and sell them in the same hour. When you move to the alternative, like the 25% you see here, really the fundamentals of the company are what drive the price of it. It has nothing to do with the volume of trading. So if 1,000 people sold it today or 1,000 people bought it today, it's not going to move how much it's worth. We quite literally get third-party appraisals done on real estate assets that we own, and that's what drives the price of it moving into the future, which gives it a lot of predictability and stability moving into the future. Now, we're starting to see more and more of the smart money, which is pension plans, moving more money into these type of assets, which I'm going to show you in a minute. But really, in my personal opinion, you need to have some type of alternative investments for your portfolio to be considered diverse today. As I mentioned, I like to follow the smart money, which, when I say the smart money, I'm talking about pension plans, the Canadian pension plans. So things like OMERS, CPP, OTPP, like these are like your doctors, your CPPs, your Canadian pension plan. So everybody's on that, your teachers, unions, all of those type of things. Now, the reason why I like to follow these investors specifically is because they have a fiduciary responsibility to their pensionees to make sure that there's money there for their pensionees when they go to retire. They're responsible for making sure that they're making prudent investments that are lower risk, but are also able to provide what they're looking for their pensionees when they go to retire. These are the most sophisticated investors in the country. So I like to see what they're doing as a trend. If you look back to 2005, again, you can see this graph. I don't need to lay it out, but 14% is what they had allocated to private investments. If you fast forward to 2022, they had over half of their books allocated to private investments. Again, prior to 2015, these were only available to institutions like this. They weren't available to individual investors yourself. So you wouldn't have even had the option to make these investments. But the fact that the smart money is moving in the direction that they actually have more than half of their investments in this asset class, let's call it, really goes to show the predictability and stability and the good returns that this type of an investment has to offer. And in my personal opinion, it's a no-brainer that people should have at least some of their money in this type of an asset class. Here at Equiton, we offer 3 different investment types within this space. Now I'm going to go over each one of them with you individually, but this is kind of a snapshot of the 3 different options that we have. We have our apartment fund on the left, which we target an 8 to 12% net annual return. Now, whenever you're getting quotes from anybody who's looking at giving you a return, make sure they quote you on the net return. Net return is what you put in your pocket at the end of the day. Gross returns don't matter, because if they're charging you a fee to essentially invest with them and they're taking a piece of it, well, then it doesn't matter. But you actually put in your pocket at the end of the day is what matters. So if you're getting any type of quotes for any investment, always ask them what the net is. Make them lay their cards on the table. So our apartment fund is essentially just a portfolio of really large-scale apartment buildings. Let's backtrack a little bit, actually. All of these investments have the same structure. Here at Equiton, what we do is we allow investors to get real ownership of Canadian real estate in their portfolio. What do I mean by that? Let's look at the structure of the funds, because I think that that tells the story really well. Each one of these have their own mutual fund trust. Okay. Now, mutual fund trust is just the structure that we opened it as, because that's what allows us to take people's registered monies. So this is why we can accept your RSPs and your TFSAs. Okay. And what we do is we sell units of a trust, which, think of it like a stock. Now, in one way, it's very similar to a stock because it's shared ownership. In another way, it's very different because I associate volatility with stocks. I would never expect these investments to go down. These investments should always be in a plus position because of something I'm going to go over with you in 1 minute. But we sell units of a trust to individual investors such as yourself, which gives you direct ownership in whatever that trust owns. So we buy properties within the trust. Now, our investors literally own these through proxies of units of a trust. Equiton does not own these. We come into the pictures as either asset managers or developers, depending which side of this model you fall into. Why that's important is because you have direct ownership in real estate assets, so you're entitled to a portion of the profits that these assets create. Let's look at the apartment fund first, because it's the easiest to explain. Quite literally, it's just a portfolio of large-scale apartment buildings. So at this point, we own 34 different buildings that are worth roughly $960 million, and we manage about 2,700 individual doors within this portfolio right now. So I look at this as a direct alternative to owning your own rental property. The reason why I say that is because, as you can see, you get monthly distributions and capital appreciation. Well, what does that mean in English? Let's look at it as if you were to own your own rental property. If you own your own rental property, you make money in 2 different ways. You have a renter paying you rent every single month. That's a monthly distribution. And you also own a physical building. That's the actual house that you own that you're renting out that is appreciating in value. And when you sell it over time, you should make money off of it, right? That's capital appreciation, because it's the appreciated value of the actual house that you own there, right? Our apartment fund does the exact same thing, except now you're getting a piece of 34 different buildings, not one individual property, which lowers the risk. You also have 2,700 individual people who are paying you rent on a month-over-month basis instead of 1, 2, 3, 4 like you would in a single-family home, which again lowers the overall risk profile of it as a whole. So the apartment fund is a direct alternative to owning your own rental property, because if you buy into this, you're quite literally owning a piece of a really large rental portfolio rather than buying your own rental property. And it comes at a little less risk even further than the diversification you're getting within the portfolio of Equiton, because we are doing this day in, day out. This is our full-time jobs. We are running financial modeling. We are doing due diligence on properties. We are looking for deals to buy. We're looking for the best way to spend our money so that we can raise the value of these buildings over time for our investors. So you get to take advantage of the expertise. Not to mention, you don't need to secure financing. You can use money in a registered account if you have money just sitting there, again, a TFSA RSP, and you can also invest in this portfolio for as low as $25,000. You don't need to come up with hundreds of thousands of dollars for down payments. We're going to go into each one of these individually, and I'll tell you a little bit more about the not structure, but the outlook of this portfolio as a whole. But let's move to the next one. The next one's called our Income and Development Fund. This one is for people who are looking for a little bit higher returns, maybe 8 to 12. It doesn't get you going, but something like a 12 to 16 might. Now, with this fund, we have the income portion and the development portion. We have commercial properties, we have lending on the income portion, and we have development properties on the other end. Now, again, you get ownership in everything. So if you look in the middle, you get monthly distributions, you get a little bit of capital appreciation, but I wouldn't say it's the same as something like an apartment fund, and you get special distributions. The monthly distributions for the apartment fund and the income and development fund is set at roughly 6%. So roughly 6% of your annual return is going to come through a monthly distribution, and the remaining portion is coming through the other profit centers. On the apartment fund, again, that's 2 to 6% that you're getting through capital appreciation. On the income and development fund, we own commercial properties. They don't necessarily appreciate as fast as multifamily because you don't have tenant turnover as much. With commercial properties, you're more looking for cash flow. You have long-term leases. You have what's called a triple net lease as well, meaning that you can push all of the expenses that are incurred to your property onto the actual people who rent it. So think of things like insurance, think of things like snow removal or landscaping. Usually the tenants pay for those. So the appreciation isn't as high, but in this portfolio, you have special distributions, which comes from land development projects. So land development projects, right now we're focused on mid-rise condo buildings. Now, the way a condo works is, again, just think of it if you were building something yourself. You're building something up, there is no cash flow coming in, there's no appreciated value of it until it's actually completed and you sell it off. And then you get a large influx of cash come in at once, which we distribute to our investors in the form of special distribution. So that's a one-time payment that you get from a development project, and then it ceases to exist from the fund altogether. Now, the cool thing is we're constantly doing projects, so you always have something to look forward to. Within that fund, we actually have 4 different development projects that should be paying out over the next 5 years. Now, the only thing with this one is I look at it as a little bit longer term. I usually recommend a minimum of 7 to 10 years in a fund like that, because the special distributions from the land development projects are going to directly affect how much money you make. This fund is also a little bit lumpier. Notice how it says target annual net return. I think of this one as more of an average annual net return. Okay. And the reason why is because in years where no land development projects come to fruition, you're likely only going to get that 6% that I was talking about that's being derived through the income portion. Remember, that's renters paying rent on our commercial properties and interest that we're earning off land and construction loans. Okay. But in years where development projects come to fruition, you'll get that special distribution. You could have a 20 to 25% return in that year. Because you got, let's say, 15 to 20% almost from the special distribution, plus you got the 6% through the monthly distribution that you're getting. Okay. So let's condense it to a 3-year time frame just for illustrative purposes. But year 1, you get a 6%. Year 2, you get a 25. Year 3, you get 6%. Well, now you should average somewhere between 12 to 16%, right? So it's a little bit more lumpy. But again, I wouldn't call it volatile because these type of investments should never go down. They should always be in a plus position. And that's part of being a private investment, which I'm going to go over with you in a little bit further. Then there's the people who just want to hit a home run. That's the development offerings. I call this the home run because this is really from a year over year return perspective. This is where you could really get, I mean, look at it. It's 16 to 20% that we're looking to target for our investors year over year. Now, this type of an investment model is a little bit higher risk because you're investing in one specific development. Excuse me. But the return structure also looks a little bit different on this because this type of an investment, you put your money out, you don't see any type of return until the building's built and sold off, and then you get all of your investment in the form of one lump sum payment. So although it's 20% year over year, you're going to get like 100% all at once 5 years after the fact. Now, again, a little bit higher risk, but a little bit higher of a reward. Very easy to explain, but let's see what that looks like. Let's go into this a little bit further. Let's look at our apartment fund. So our apartment fund has never had a negative year. Okay. As you can see here, let's take out Equiton as a whole because we're just one company. But you can track these kind of investments for our apartment fund through what's called the Canadian Private Apartment Index. Now, as you can see, it's very, very steady, very, very safe, very, very tried and true. This investment class has never had a negative year in over 39 years, which, I mean, I don't mean to make myself sound young, but that's longer than I've been alive. This industry as a whole has never had a negative year. That includes Black Monday, the global financial crisis, COVID, the inflation crisis, and everything in between. Now, I know this is a busy slide here, but I really want to focus on the predictability and stability of this type of an investment. When you look at Canadian private apartments specifically, the reason why they're so predictable and stable, again, is because of how they're valued. So again, let's look at Canadian private apartments, which is the orange box, and let's compare it to Canadian equities, which is 2 over, which is the Canadian stock market. Now, Canadian equities are extremely volatile because what values them is the volume of trading, like I was saying before. If people buy it, it goes up. If people sell it, it goes down. And because of today's world, the digital world and influencers, it goes up and down like a yo-yo. Okay? When you look at Canadian private apartments, the reason why they're not volatile is because, again, of the way they're valued. What I mean by that is we quite literally get third-party appraisals done on every building that we buy. Once per year on the anniversary date of when we bought it, we get a hard appraisal done. And what we do is we buy underperforming or undervalued existing buildings. And when you move to multifamily rather than single-family homes, they're valued based off their net operating income. So that's revenue minus expenses. So if we're buying buildings and continually having turnover in the units or continually upgrading the buildings, by theory, they should always be moving in a plus. And the numbers back it up. If you had invested in Canadian equities for the last 35 years, the best 1 year over year return you would have got is 35.1%, which is fantastic. But the worst is negative 33%. That is a huge fluctuation. That's a 68% fluctuation on your dollar. Now, I don't care who you are, you're saving for something, whether it be putting your kids through school, whether it be saving for your own retirement, or who knows, maybe you just want to buy a Ferrari. Who knows? Everybody has different motivations for wanting to save, right? Heaven forbid your money was in the negative 33% year when you wanted to retire. Now you're left with 3 terrible decisions. either wait it out, continue to work, either get a loan and have to pay it back, or take a loss on your money. None of those are ideal. Let's move over to the Canadian private apartments. Best year over year is a respectable 22.3%, but what's more important is that lower number. The worst year, you were still up almost 2%. What that does is it always leaves you in control of your money. No matter when you wanted to retire, no matter when your kid was going to school, or you just wanted to splurge and buy that Ferrari, your money would have been sitting there waiting for you. Plus, we saved you from pulling your hair out when you're looking at your portfolio and it's down 33%. Nobody wants to see that. Always in a plus position. So we completely eliminated the volatility, and we're keeping your money there for you when you want to spend it. Lastly, let's look at the averages. Canadian equities, you would have averaged 9.4%. Canadian private apartments, 9.9%. So we actually beat them. So if you left your money in the Canadian private apartments, you would have made more money at the end of the day. Now, these are some of the reasons why we're seeing the smart money put more of their assets in these type of an asset class. Why these pension plans are trusting these type of funds more. And the only reason why you don't have it in your portfolio today, to me, is because people didn't know that these existed prior to 2015. Again, our strategy within the apartment fund is to acquire underperforming or undervalued existing multi-residential properties and be actively managing these on behalf of our investors to raise the value of them over time. Again, 8 to 12% is our targeted net annual return. 6% comes through monthly cash flow. The other 2 to 6% comes through capital appreciation, which is the building values moving up over time. The income and development fund is the one in the middle, which we spoke about as well. Again, we want half of it to come through income producing assets, which is commercial and industrial assets that we own. We have the lending as well, which is part of the income producing. We're mostly focused on land and construction loans, not mortgages like you or I would have. Plus, every development project that we do, 10% of the capital that we need raised comes from this fund. So 10% of the profit goes to the people who are invested in this fund. Again, 50% income producing, 50% development projects, 12 to 16%. You should stay in this a minimum of 7 to 10 years in my mind. 6% comes through monthly distributions. I would say max 1 to 2% through capital appreciation, and the remaining through the special distributions that you get through the development projects. And then we do have a development project right now that's open for investment for those people who want to hit the home run, want to get the higher returns. This one is 1099 Broadview. We liked the address so much that that's what we named it. 1099 Broadview is right at Broadview and Danforth, just north Toronto. It's a 12-story condo building, about 355 units. Looking right now at about 5 years. I know it says 5.17, but we've been raising capital for about 2 months. And the estimated completed value of this project is $386 million, which we're looking at averaging 20% for our investors on this year over year. So 5 years, you should expect a little over 100% return. We're looking at 103.3% 5 years out on your dollar. That's a net return. That's what you should put in your pocket at the end of the day. This one is also as low as $25,000. And again, all of the registered plans eligible within it. This is kind of showing you a snapshot how close it is to downtown. I'd love to go over this with you guys in a little bit more detail. If it's something you're interested in, we can talk about it a little bit more. Currently, the closing of the property is actually in 8 days from now, where we close on the property. Then we go through the site plan approvals, the sales, and the construction. Something cool about Equiton is we do it all in-house. All of our investment solutions, you're looking somewhere between 8 and 20%, which, again, if you're looking at your portfolios at the bank or your TFSAs or RSPs at the very least, I'm sure these numbers look attractive to you, especially considering what's been happening in the public markets over the last few years. Plus, we can give you that peace of mind with the predictability and stability like we were talking about before. Again, I can't stress it enough. Use your registered plans. Get these things, get your money working harder for you. That's extremely important. Keeping your money above inflation is the difference between being able to retire and not being able to retire. The difference between your kid paying for half of their schooling and you being able to do it all for them, or being able to make that lifestyle change. Make sure that you're having your money work as hard as it can for you. Again, last chance, use the QR code here. You can set up an introductory meeting. If after the fact you would prefer just to speak with Ava or Sophia, they're very knowledgeable on this as well. They can answer some of the questions that you have, or just push you directly to me if it isn't something that they know off the top of their head. And they can set up an introductory meeting or do a warm introduction with me personally. So feel free to go either route, whatever feels best for you. Have to do the notes and sources, have to show you the disclaimer, which is essentially, although I am very research based and I have a lot of knowledge on what's happened in the past, it's not necessarily indicative of the future, but in my mind, it paints a picture. So you guys can see that stuff. I'm going to come back here just so that you guys can see that one more time. Let's exit out of here now. Actually, if you guys can take me off the shared screen, then they can see my my beautiful face on on the screen again, and I can
There we are.
you guys have.
Fantastic. Thank you so much, Kyle. We really appreciate you taking the time to present this to all of us here. You did a fantastic job, as always.
Thank you so much, Kyle. Amazing. Loved it.
Let's dive
problem.
right into the questions and answers. And we do have a question actually from Human. He's asking, does Equiton Capital work with any trust companies that allows to bring our registered funds to Equiton?
Yes, we work with two. So one of them is Olympia Trust, and the other one is Odyssey Trust. Now, I'm all encompassing, as with any of the advisors here, actually. So if it is something of interest, what we do is we would just get you to give us either a credit card or your banking information, because these institutions do charge nominal fees like any bank, which is typically somewhere around $150 a year to have an account open with them. And they require that on file, but I would work with your current institution, whether it be somebody like a big bank, like a Scotia RBC, or if you have a private wealth company, to move the monies over. We do that all in-house, so you kind of get to sit back, not worry about it, and we take it all on.
Yeah,
Perfect.
that was an easy experience for us, definitely, in this respect.
No kidding. If you guys have any questions, please feel free to put it in the chat. In the meantime, I know for myself, when I first started talking to Kyle, I had a question too, because I'm also a little bit younger. You know, I just started my career not too long ago. I love taking a little bit more of a risk. I have a longer time horizon. And my first question to Kyle was, you know, where do I get started? What would be the best fund for me? And I'll let you answer that, Kyle.
Yeah, I mean, typically with people who are younger, they have time on their side. I really like the income and development fund as well as the development projects, just because, again, when we looked at the income and development fund, you can really maximize your returns over time. And if you look at any yield curve, let's call it, so those are like the graphs of showing how much money you make. Typically it goes like this, and then in those later years, it really starts to spike. So if you have 10 plus years, let's call it, where you can put something in and it's more of a set it, forget it type thing, you know you're not going to need to cash it out anytime soon. You know you're not going to need it. I really love those higher yielding products because they will get you further ahead quicker. With that being said, if you're over time and you're continually contributing like every year, getting a little bit of the apartment fund in it as well, I do see as an advantage, because you get further diversification within your portfolio as well. But you have the advantage of being able to look at it from both sides and being able to determine how much you want in a little bit higher risk, higher reward, and how much you want in more of the tried and true. You know exactly what to expect out of it year over year, and getting a full diverse portfolio. So to answer your question, every situation's a little bit different, but you specifically, Ava, in the situation you were in, I think we like some of those more higher yielding, especially in the beginning, looking long-term RSPs.
Exactly. Yeah. I went with the development fund, the vicinity.
So then actually I'm on the opposite side, don't have that much time. I will have to turn my RSPs into RIFs, etc. And why did you suggest to me the apartment fund? What's the reasoning behind that one? And I would like you also to tell us what the amounts for each fund is you can contribute. What's the minimum amount?
Okay. Let's start there. So the apartment fund's 25K to start. The individual land development projects are also 25, and the income in development is actually only 5,000. So you get involved for as low as 5K. Now moving over to the second portion of that, for Sophia, we determined to put all of her investment just in the apartment fund. And the reason why is something she just mentioned. Number one is that it will be moving to a RIF. Now, just for people who don't know what that means, when you have an RRSP, it's a retirement savings plan, okay? Registered retirement savings plan, RRSP. When it moves to a RIF, it's a registered income fund, meaning the federal government is making you take money out of it. So you're going to have a minimum withdrawal that you have to start taking out. This happens when you turn 71, okay? You need something that provides you the liquidity to be able to take it out at that point. And I really like our apartment fund because a portion of the return comes through a monthly distribution and a portion comes through appreciation. Okay. So that monthly distribution at 6% will actually allow her to take that cash flow when it is needed, when she has to take it, and satisfy a requirement through the CRA until she's about 77 years old. Now, something I really like about that specifically is that not only are we satisfying her requirement through the CRA, but she's still earning because she's still getting that capital appreciation portion, which should keep her underlying investment above and beyond regular inflation. So it's a way that we can make sure that she's satisfying her requirement through the CRA and she's earning as much as possible. That's one side of it and why that fund specifically makes a lot of sense. The second side of it goes back to the smart money, goes back to the comparing of the Canadian private apartments to the Canadian equities. Typically, when you're moving into the latter years of your life, let's call it, you're going to need this money. You're going to be relying on this money to pay your bills moving into the future. You saw how predictable and stable it is. You saw that it's never had a negative year in, again, longer than I've been alive. So having that predictability and having that stability makes me feel really good about putting yourself, Sophia, into it, because I know that those dollars are going to be sitting there waiting for you and readily available when you need it most. So from those two sides of it is why it made a ton of sense and why I decided that that would be the best portfolio for yourself moving into the future.
Fantastic. And you also gave me an option in regards to the monthly distribution. What options do you have? Maybe you want to elaborate on that one too?
Yes. So this is actually both for the income and development as well as the apartment fund. Keep in mind, 6% of your return comes through a monthly distribution. Okay. Now, if you're investing through an RRSP or something like that, it doesn't necessarily make sense for you to be taking the cash flow every month because that's counterintuitive to what an RRSP is. You're trying to put money into it to get money back and defer that tax burden until down the line. So in a situation like that, rather than us actually giving you money, so we pay that monthly distribution on the 15th of the month, like clockwork, like a paycheck. Now you can either determine to take it as cash, we put it right in your bank account, or you can do what's called our direct reinvestment plan or our DRIP program. In that case, rather than giving you physical money, we're giving you more and more units of the trust. So it's building your portfolio. Now you're compounding in two different ways because you're getting more and more units every single month, plus they're growing in value. Those stay in your portfolio. So when you sell at the end, or when you exit your position with Equiton, you just have a larger amount there and you're in control of it a little bit more in that case.
Mm-hmm.
Thank you.
Great question.
Yeah, we loved it, that one about, I'm just looking at the time. I think we kind of have to wrap it up here. I think you did a spectacular job because there's not many questions out there. So you really nailed it.
Yeah, very detailed.
Yeah, if there are any further questions from anyone, please always feel free to message us or let us know. You know, we can always find out the answers for you or connect you directly to Kyle. You can just email us at yourpropertyduo@gmail.com, or you can just give us a quick shout. Then what I also wanted to mention at this point is we are really excited for a few things that are coming up soon. We will have a few more events. The next one is coming up on July 20th at 11 a.m. It's going to be an in-person event in Richmond Hill with one of our mortgage guys, Lino Contento. And he's going to go through how to take money out of your existing home and how to use that and actually buy an investment property. And then what a lot of our clients are taking advantages of is our real estate action plans. And we love to combine it, and that's where we actually introduce Kyle a lot of the times as well, and Equiton as a passive opportunity, but we go through passive opportunities as well as active opportunities and really see what it is that you are looking for and what your long-term goals are, what you're struggling with, or where you might need a little bit of help, and then we see how we can hopefully help you along the lines there as well. So this one you can just message us and we can book it, or you can also book it directly through our link. I will send our details in here shortly as well, just so that you can book it directly if you wanted to. There we are. And yeah, if you have any questions, we're always happy to help. And we can't wait to send out more and more educational events and content like this. And again, we thank you so very much for joining us on a Saturday. You could have been anywhere in the world, but you chose to be with us. So we feel really special and happy.
Honored. Yes.
Yes, no kidding.
And Kyle, thank you too.
Yes.
Thank
Of course,
you,
always happy to be here. Love to educate people on this side of the world. So anytime you guys want me out, just let me know.
Fantastic.
We will.
Thank you, and wishing everybody a fantastic weekend.
Have a wonderful one.
Take care.
See you next time. Bye, everyone.